The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. Yourself?
I'm great. How's this weather?
Oh, I love it.
I know it's a lot better.
Oh, man. It was getting hot.
Oh, I told you I was at a gas station filling up, and it was 107 degrees or something. And it felt like when you open up an oven, it's already like, whoosh. I was like, whoa. And that was in the shade. So my wife said, we need to go out in a boat. And I said, are you kidding me? I'm going to bake out there.
You were happy when you sold your boat.
Oh, I know. Now that's all that she wants now is a boat. Oh, my God. No boats. I had enough. What's the happiest day? The day you get a boat?
Well, that's
the next happiest day, the day you sell a boat.
That's not a true boat owner.
Yeah, that's because you just bought a boat.
There you go.
I think you agreed with me till a couple months ago.
Oh, no, you didn't.
All right. Remember, on this show, we try to answer your financial questions. I actually listen to a lot of the other financial shows. Sometimes I hear a nugget here and there, but most of the time it's just a sales pitch about my next seminar or my next, this or that, instead of really teaching you stuff. That's what we try to do here. Obviously, we do it because we hope people will become clients of ours. But this is information you can use right now in your financial lives. And some of the stuff with finance over the years, I would like to say it's become less complicated, but it's not.
No, not
become
true
more
at all.
complicated. A lot of it, they say it's because companies are trying to make more money. It's really not that. We live in a zero interest rate environment.
Well, and speaking of that, I wonder if the Fed's ever going to raise rates again.
Oh, I have no idea.
I thought for sure they were going to here.
Well, like I said, if they raise them too much, it's committing suicide because of the $19 trillion in debt we have.
I've heard pundits say that they missed their opportunity, their window 18 months ago, and they're really like a 5-foot man in 10 foot of water. I mean, they're really coming out against the Fed now, saying they've missed the boat. They don't know what they're doing. They can't get back in the game. It's hurtful.
It's, the zero interest rate, right? People are searching for yield. That's what's kept the stock market up so long.
Absolutely.
I mean, people are really looking for yield. The more people buying dividend stocks now. I was looking at this. A lot of people buying utility stocks.
Sure.
But right now they're at PEs of 18. 18 times earnings, which is traditionally really high for a utility
company. Yep.
And so, it's pushing the dividends down. Or some of them are paying dividends and don't have the actual cash. They just always pay dividends. So there's a real danger in that kind of stuff. And that's why dividends, stocks in general, were never designed to pay your bills. They have never, ever been designed to pay your bills because it's not consistent, predictable income. It can be there one day and gone the next. It can be higher or lower.
And you have to worry about the value of the underlying asset, meaning the company's stock.
I mean, CDs, bonds, annuities have been traditional things to pay bills with.
But you can't use those much now.
Yeah, you can use them. It's just if you're okay with the 10-year bonds are 2%.
Oh.
5-year CDs are about 1%. Someone called me the other day, said I've got about $3 million selling my business. And I think the bank's paying about 5%, right? So I should get 5. I said, where have you been?
I hate to
5%.
I hate to admit this. I've got a CD paying 0.2%.
Ooh, that's a good one.
I was looking at the file today. What are you doing?
Because it's better than the 0.01 if you don't put it in a CD, right?
That's true.
But that is what the world is. There have been a lot of products come out. Your index annuities, some of your equity-linked CDs. All of those things have come about because we live in a low interest rate environment and people are looking for at least potential levels of income because you can't get it anywhere. Somebody was asked me, are annuities popular because commissions are higher? Well, the truth is commissions aren't any higher than they were in mutual funds.
I would argue that commissions are lower. If you get a flat fee up front opposed to an ongoing 1 or 2% on a growing asset, which is going to be more?
It has nothing to do. It has to do with the economy.
right.
Right now, we live in a zero interest rate economy. We have a market that's topping out 7 years in a row. It actually hadn't gone up in about it. It's weird. Every day I hear the news because I listen to the news.
All three indices are higher than ever. New
higher
records.
cap. But a year and a half ago, the S&P 500 is about the same as it is now.
Yeah.
It's made like 1%, 2% since then.
But it's a new high.
But it is
it's
a new
record.
high because it went to that cap a year and a half ago,
Yeah.
went down, then it went back up.
Yeah.
So the new high stuff makes us feel good, but there still needs to be a correction because you can't have six negative earnings quarters in a row in the market. Last time that happened was 2007, and we know what happened in 2008. You've got just too many indicators. The PE ratio is higher than it was in 2007. Now, I'm not advocating or implying that the market's going to crash 50, 60% again. But I am saying, because companies have more cash than they had back then, banks have more cash than they've ever had in history, percentage-wise. So if that's the case, I think it's going to be less. But I'm talking about 20 or 30% definitely could be in the cards.
You know, and this is just an opinion, but there's a lot of indicators out there. And the Fed, we're going back to the Fed again, they're talking about the Fed not really wanting to do anything until after the election, right? They don't want to cause the market to crash or whatever prior to the election. So if we know or think or believe that they're not going to do anything until the election, if you've made a reasonable amount of gain, and we talked about rebalancing last week and a few things, and you need to rebalance or you just need to take some off the table, you know, it may not be a bad time to do that.
The all of this always reinforces that our motto here at Dillon Gage and our thing about take care of your expenses in retirement first. Then the stock market is a great place to help fight inflation long term. I know we're not making as much return lately, but long term it is an effective inflation fighter as long as your bills are paid, because the market was never designed to pay your bills. I read another big research paper from the Center for Retirement Research.
Right.
It was talking about, with all the benefits annuities offer, why don't more people buy them? And I was like, yeah, why don't they? Because if you look at anything, you've got, let's say I've got a CD paying me on $1 million, I get 10 grand, 20 grand. A bond, 20, maybe 30 if I'm lucky. Annuity paying 50, 60 to 100. Why wouldn't somebody do that? The people are still thinking of antiquated information. It's still in their head. There's still a bias there where they think that there's going to be a break-even point. It's the reason why people take Social Security so early, too. There's a break-even point in their head. They're like, if I buy an annuity and if I don't live to 82, I'm going to miss out. So that potential loss is going to prevent me from ever thinking about an annuity. But that was the old days. That was annuitization that nobody does anymore.
Very good point. I think a lot of people do, because you have to commit to time, even though you have access, penalty-free withdrawals, etc. I don't know if people want to commit to the time. Sometimes they think, well, the market's going to, or the interest rates are going to go up, and if I'm in this, I can't take advantage of that. And if you really put a pencil to it, interest rates would have to go way up for that to hurt you.
That's right. Remember, if they go up just to where they were 5 or 6 years ago, we're going to have $500 billion more in interest payments on our treasuries. That's like financial suicide. The government is not going to raise interest rates that high. It's just not going to happen. We live in a different world now, and that's what we have to. The government's already said, we don't care about you savers and retirees. You know what we care about? Keeping this economy moving. We care about them housing. Look at the housing. Housing keeps going up because interest rates are low. People don't buy a price of a house. They buy the payment. They go, wait a minute, $3,000 when it used to buy me a $300,000 house, now buys me a $600,000 house? Are you kidding me?
I know, right?
So buy the big, and that's what people do. It's human nature, and so they don't care. And also, besides housing, companies, when they want to expand, they can borrow at lower rates. So it
promotes growth,
that's
for
right.
sure.
Municipalities, get this, municipalities are receiving in taxes, right? They also have to borrow for infrastructure things, but so they're receiving higher taxes because the valuations keep going up because interest rates are so low, right? And they get to pay less interest on their municipal bonds.
Yep.
So it's a big whammy. It's a deal that sets up for, if you're a municipality, a government, anything like that, low interest rates make everything right. High interest rates can hurt a lot. And so, unfortunately, for all of the savers and the pre-retirees, they don't care. So this is the world that we live in. And I think everybody has to just live with it. And I have people that tell me, I'm waiting for CDs to get it back up to 6 or 7%. I had somebody call me this week that gold's going to be, the dollar's taken off the world currency. It's going to some other made-up currency this week, and you got to put all your money in gold. All that is ridiculous. That's just somebody trying to sell you gold.
Yeah, but sooner or later, we're going to have to pay the price. I mean, we don't have the earnings. We get through the election. The Fed's going to, you would think, you assume they're going to have to raise rates again. So if you've got your expenses taken care of and you've got your allocations correctly, it's less of a stress point for you, and that's our point.
I know. If you listen to the Republicans and Democrats, say if you lower taxes, everything goes better. Democrats, if you raise taxes, everything goes better. Unfortunately, it's more complicated than that. There's a lot of other issues that have to come into play, but raising interest rates hurts just a lot. It helps savers, but hurts pretty much everything else. Oh, we got a break coming up, but we're going to go over your questions when we return. Remember, if you have any financial questions, you'd like a quote, or if you'd like us to give you a no obligation, no cost retirement plan or Social Security optimization, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Today we're going to go over your questions. Beforehand, remember, all of our listeners, we offer a complimentary, no obligation retirement plan. Everyone out there, if you're over 50, if you're under 50 but contemplating an early retirement, needs a written retirement plan. It's amazing to me. Some of my friends over some big firms, friends and relatives, by the way.
That's true.
They say they don't do any retirement plans for anybody. They'll talk to somebody for a few minutes and give them a recommendation for their entire retirement. I go, are you kidding, right? How do you know have you factored into inflation into their actual expenses? We don't know their expenses. We just think that everybody should be in this mutual fund, this managed account, this selection of mutual funds, just based on a risk tolerance. I go, but inflation could erode their purchasing power later. What are their expenses? Or when do they want to retire? They don't care about that stuff.
It's kind of like recommending a product for someone, be it an ETF, managed funds, be it a fixed annuity, being it bonds, without having the whole picture. You have to make sure you're not doubling up. You got to make sure one helps the other, that dovetails together. You can't even sit down with somebody and really recommend a single product unless you have the whole picture.
And that's what we try to do, is give you the whole picture. Honestly, I've had people, very smart engineers and everything, and they didn't realize how comprehensive this program is. It does a lot. It might show you 20 different lines for your different years, but inside those 20 years are 100 different calculations. It factors in cost of living adjustments for Social Security, inflation to your expenses, any decreases in, let's say you're going to pay off a house in a few months or a few years, raises at your company, how much you're putting in your 401ks, how much you're matching with your employer. All of that stuff is put into one place. And then you can stress test it if you like, or give a minimum return to it and actually see where your money is, instead of some Monte Carlo simulation that gives you, it's got a 90 percentile of doing this and that. Most people, that means nothing to anyway.
It's confusing.
We're giving you real numbers. Like I said, there's complimentary, no obligation.
What this does is it takes a complicated situation, your expenses, we've talked about it a lot, your income, what you're going to need, what you have saved, and it reduces it for you and really puts it on a couple pages where it's real easy for you to look, understand, it's comprehensive, and then you file it, and you can pull it out, and you can review it, and you can make adjustments. It really simple. I know it sounds complicated if you're listening because it does all this, and it does, but once it's done and it's on paper, it really simplifies your life.
And a lot of people think that because of Social Security laws, they got rid of some of the file and suspend stuff a while back.
Right.
That you still don't need a Social Security. No, there's still a lot of great techniques you can use with Social Security, and we'll do that complimentary as well. Our number is 972-715-2424. If you'd like to take advantage of that, it's 972-715-2424. You can always go to our website at ilovemyretirement.com. All right, Guy, let's go to your first question.
All right, first question. Here's a hard worker. I work for two companies. I have a 401k at one and a simple IRA at another. Can I put the maximum in each plan this year?
The short answer is no. What happens when you work?
Well, you could. It won't end well.
What you have is, remember, 401ks. Here's the easiest way to think of it. It's all on the employee contribution. 401ks, you have an employee contribution, then employer matches or whatever. Most of them don't match much anymore. They'll put a little bit sometimes.
And it's getting lower.
That's right. The employee part is going to be limited to the maximum of each one. In other words, you can't do more than let's say if you have a simple IRA, I think it's 12,500 or 14,000, but the other one is 18,000 or 24 if you're over 50, right?
That's right.
It's going to be limited to the maximum. You can't put more than that 24,000 if you're over 50 or 18 if you're under 50 in the combination of the two.
Otherwise, you just open up 3 or 4 different IRAs and save all sorts of money.
That's right. And remember, the government doesn't get taxed. They don't get their tax money on that stuff, and some people don't pay it for 30, 40 years. They don't like that. So the combination. Now, that's not really the end of the story. There's the other part, the employer part. So let's say you work for a company, but you also have a side business, where it's just you and your wife or just you. You can open a SEP IRA there because you can put up to $53,000 of your income from a SEP of your side business into the SEP. And that is not considered an employee contribution. That's an employer contribution.
Correct.
And it doesn't limit employer contributions. Now, employer contributions on these two companies, like if you have match on each side, if they're related companies, they're going to combine for that $53,000 max between your contributions and the company. But if they're not related, you're going to actually max out both sides. It just can't be employee deferrals can never go over the limits. But employers can unless they're affiliated companies. Like let's say I own this company, I own this other one, and I own this other one. Well, that's going to be, in other words, the one you work for, you can't own that one just because you own the other one. But SEP is probably the best thing. We've talked about this before. SEP was called Simplified Employee Pension IRA. Allows you to put in like up to $53,000, write it right off your taxes and put it in a tax-deferred vehicle. And you can invest pretty much anything you want in it.
Yeah, and if you're not sure what to do and you have some questions other than the Social Security program, which we're happy to run for you, give us a call. We'd love to talk with you, and we can walk you through it, show you your options, and allow you to make the best
qualified versus
choice.
Non-qualified. Like 457 plan is a government plan. That is the only one they make an exception to because it's actually a non-qualified, even though it looks exactly like a 401k. So you could do both on a 457 and a 403b and a 401k. But 457 is the only thing you can do. Remember, if you have any questions about that in your particular situation in multiple employers, don't hesitate to call us at 972-715-2424. All right, we have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. All right, today we're going over your financial questions. These are financial questions that we get either in emails, personal interviews, anytime clients call in, have a specific question. If I think they're going to appeal to a broader audience, we're going to share them with you. We don't use names to protect the innocent or the not so innocent, but every time I hear one, I think the audience would like the answer to that one because that's what we do 90% of the time is just answer people's questions. You know, when you become a client of ours, anytime you have a financial question of any type, we're either going to know the answer or we're going to get you the answer. All right, what's our next question?
All right, this one comes from a listener every week, says, I love your show. I especially appreciate the financial expert you've got on the show, Guy Allard. Not only is he good looking, he's one of the sharpest minds I've heard on the radio.
Now, this was your mother for sure.
And it goes on for 4 or 5 more paragraphs, but I'll cut it short there. And he goes, the question is, how are you compensated? What, you don't believe me?
Well, I never done. Yeah. How many of your relatives listen to the show?
All of them.
It depends on the type of service that we provide. Remember, we have no charges for retirement plans, Social Security optimizing, or questions. More importantly, you got questions you want to quote, anything like that. We don't charge for that. All right, that is all on you. There's no obligation and no charge ever.
And one of the good things, if I could jump in on the annuity part, we certainly get paid and compensated on a commission basis on annuities, but It doesn't come out of your money. If you're putting $100,000 or $500,000 and we're working out an income plan for you, if you put in 100, you end up with you start with 100, or if you're putting in 500, you start with 500. It's not less 3 or 4%.
It's one of those good things. I get paid, but you don't have to pay it. That's why they have penalties a lot of times on annuities if you cash them out early.
That's right.
Because they've already compensated me, their own staff. And so if you get out early, they got to recoup some of this money. There's nothing wrong. We also, with the fee-based stuff, we basically charge 0.5% to 1%, and that's pretty standard.
Depending on the size of the
law,
account.
the standard throughout the whole industry about 1.25%.
And a lot, if I can add in on that also, a lot of the managers we use, and we use Fidelity as our platform, a lot of them have minimums where you'd have to have $10 million or $20 million before they'll manage your account. But in using us and going through Dillon Gage, we can get people in with much smaller minimums.
That's right. I have one of them that's $400 million minimum.
Isn't that crazy?
What happens is money managers, these these are institutional managers.
Right.
Everybody wants to manage money. Remember, they get a percentage of it, right? Not everybody wants to manage clients. And so they said, these independent advisors, if they'll manage the clients, we'll definitely take their money. You don't need $10 million. You can have it for $200,000. And so you have access at Dillon Gage to some of the best institutional money managers in the world.
Absolutely.
And you don't have to have millions and millions of dollars. And our programs, like I said, one of them is the sector rotating program that is basically in every sector of the market. There are 10 sectors in the S&P 500. Then you got alternatives, your gold and fixed income as well. Any of those sectors go below its moving average, it's automatically out of that sector. So it's got a hedge in there to protect you against down markets. Even though I love the stock market, it's gone up 7 years in a row. I don't think it's ever gone up 8. So I like something that's going to protect me on the downside, even with my market piece. If you have any questions about that, like a free information kit, is 972-715-2424, or go to ilovemyretirement.com. All right, guy, what's your next question?
All right.
No more relatives. How many relatives going to call?
Well, I don't know.
No, I'm just kidding.
Quite a few.
You
All
guys
right.
call every week.
Here's an oldie but a goodie. I'm thinking about buying a new car. I'd like to borrow the money from my 401k. Any reason I shouldn't do this?
Remember, when you borrow money from a 401k, you pay interest to yourself, right? Except for the $100 or $75 transaction.
And right now, it's a pretty low interest rate environment.
Right. So I see how it's attractive, but as a general rule, borrowing from your 401k, it becomes very difficult. It's, sometimes you'll leave the job and then
That's painful.
It's very painful. And it took a long time to save that money. If you could just not touch it, you always end up better. But I get, the natural reaction is you can borrow money out and put it back in. And if you're going to be at the job for the next 10 years, or at least through that repayment period, it's not a horrible option. I always try to look at other things first. Remember the old days before credit cards and all that they actually saved money before they bought a car? They actually.
They did that with houses. We think about cars. They paid cash for their houses.
Well, those were only like $500 back then.
Well, that's
our whole
true.
house.
30,000, yeah.
Right.
But it was a lot of money then.
Oh, absolutely. And so it's tough for me. So as a general rule, I would always recommend against borrowing from anything to buy anything. I remember in the 90s, people were borrowing on credit cards to buy stock options and stuff. Because they just knew the tech world is going up, more computers, I'm going to make a fortune.
Couldn't go wrong.
I had buddies at these dinner parties saying how dumb financial advisors were, because anybody can pick a tech stock. And I'm like, oh, okay.
People wanted to quit their jobs and trade.
All right, go ahead. Oh, what's our next question? We got a break coming up soon, but what's our next question?
That's a fairly long one. You want to go?
No, we better stop. Remember, folks, if you have any financial questions, like to take advantage of our complimentary written retirement plan, or Social Security optimization, or a combination of both, our number is 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
I want that guy, professional radio guy's voice. Allard.
Sounds pretty good, doesn't he?
Yeah, he sounds really good. It's weird, though. The radio people over the years have gone away from that.
They have.
Older people still like that radio. But everybody you hear now that's real popular on the radio, they sound like regular people.
Absolutely.
So I'm trying to go in between. So
There was a
older
country
people like
guy
me.
on a long time ago for an air conditioning company. He was just kind of a country folky
I've
guy.
actually
and-
talked to him several times.
Did you?
Oh,
Did
yeah.
he
I'm
called,
not
didn't
going to say his name.
Oh,
yeah.
yeah.
No, he did really good. All right. What's our next question?
All right. Next question is a little bit longer, a little bit more complex.
Uh-oh.
Are you ready?
Sure.
Got the Kreskin hat on?
All right.
All right. I plan on taking Social Security at 70. My wife is a teacher and has a TRS pension. Normally, my wife would receive my Social Security if I pass away. Probably should say when I pass away, because you're going to pass away. Since she has a TRS pension, would she still receive the full benefit?
Yeah, I do hear this a lot because, my wife has taught before. She's going back into it and all that kind of stuff. And I hear this a lot where one person has a job and the other one is a teacher. What happens is when the TRS is what, teacher retirement system. When you're a teacher, you don't put money into Social Security. You actually have a better retirement system than Social Security, right?
And it gets more complicated if you
That's right.
work both, right?
That's right. So the IRS does penalize you because they're like saying, hey, you didn't put anything into the Social Security, right? So let's say you worked for 15 years or 20 years in the private sector, then 20 years as a teacher. Well, they'll reduce it because you'll still qualify for Social Security after, I think it's 10 years.
For both.
Right. So you'll qualify for both, and they can't reduce your pension, your TRS pension, so they will reduce the amount of Social Security you get. Also, when normally if a spouse passes away, the lowest Social Security will drop off, and you'll keep the highest, not if the spouse is a TRS pension person. Okay? And that's, well, I'm saying TRS because it's Texas. Any state that you came from, any kind of pension, the railroad pension, any pension that didn't contribute to Social Security, which are teachers, railroads, some governments, if they didn't go to Social Security, that will count against it. I just did an analysis for somebody. I think their Social Security, we put a 2.5% cost of living adjustment. So even though it showed on the statement $3,000, it was going to be $4,000.
Right.
And the client would say, well, how come I don't get the $4,000 if my husband passes away? He's 15 years older than me, blah, blah, blah. I said, well, they're going to take it. It came out to $3,000 out of $4,000, $2,800, because they are going to reduce it by a formula. You know, the IRS formulas are always really Social Security, very
real simple.
Right? No,
yeah.
they're not.
Yeah. Oh, yeah.
Like when I have to do this, we can do it with our system, but we'll have to put in all of your earning years into the calculator, and it will tell you what the reduction will be. If the surviving spouse is a pensioner from a teacher's retirement or railroad, and the deceased spouse is from Social Security, it'll show you the actual amount that you would be getting.
You're right. You got to put in each and every year.
So it's more complicated, but the quick answer is it will be reduced. Don't believe the hype that you're going to get the full Social Security when you're, in this case, the husband died, I guess. So if you have any questions about Social Security or anything like that, because so many people there's a lot of teachers in this area, they have that, or they have something with the government, some kind of 457 plan, give us a call, 972-715-2424. This also goes hand in hand in how you start taking out of retirement accounts. All this kind of stuff comes into play, because if you're older than your spouse, you have to do some other kind of planning. It's not a normal. If you're the same age, there's a certain level of planning. If you're a different age, there actually has to be an increased level of planning, a little more detailed. Call us at 972-715-2424. All right, what's our next question?
And I'd add to that, especially if the husband is, 15 or 20 years older than the wife, it really takes some work to get the numbers to come out for her.
Because another question, I'm going to add on to that question, but I had a customer, I think he's 25 years older than his wife.
Right.
He said, well, I'm 70, I'm getting $3,000 a month Social Security. My wife's only 45. If I die, does she get my Social Security? I said, not until she's full retirement age.
I know, right?
He goes, wait a minute, 20 years? I go, yeah. So in her case, it's like 67. She can take 62, but it's going to be a reduced amount even further.
So what do you have to do? You have to plan for that gap
That's
and
right.
bridge it, right?
That's why
20 years.
There's special planning you have to do for that. Because they're not. Now, there's an exception. If you have small children, supporting children, you will get it for those, but it's not going to be the spousal benefit.
The
death
children get the benefit.
It'll be a children's benefit because you're taking care of children at that time. It'll be a disability benefit if you become disabled. But that spouse thing where the spouse gets the thing, that will not be available until your spouse is retirement age.
And again, if you have any questions on the Social Security, we've got great software that'll run you through that. Again, if you're a teacher, we add in each single year that you contributed and the earnings, and it'll spit out.
Second, how much of your Social Security is going to be reduced?
That's right.
Or your surviving spouse Social Security will be reduced. All right, what's our next question? We got time for start one.
All right, let's start this one. Wow, it's another oldie but a goodie. There are so many investment choices, and I would add also right now political and global uncertainty. I'm being paralyzed and don't know where to start.
I always that's analysis paralysis. You overanalyze everything to the point where you don't do anything.
Remember, is it
normal?
Confucius or whoever said a journey of 2,000 miles begins but with a single step?
Right.
It's the same thing. How do you eat an elephant? A bite at a time.
Right.
The important thing is you get focused and you get yourself pointed and take a step.
You got to be very careful because what happens is people overanalyze something. Even if something's a really good idea, they'll overanalyze it so much they'll find ways not to do it.
Absolutely. When
the mistake can be said, but they feel comfortable what they're doing. I don't care if you've been losing in a mutual fund for 10 years. You feel comfortable there. Nobody's going to cheat you there. It's a crappy investment, but
yeah, right.
I'm going to stay there. And so you'll default to that, not doing anything when your mistake was really not doing anything. But we got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Right before the break, we're talking about analysis paralysis. Some people overanalyze something to the point where they freeze up. Okay, I've seen pros and cons, everything, and I can't wait. I'm just going to stay with what I'm doing, even though that could be the mistake.
And if you check with enough people, you will absolutely find a handful of reasons not to do anything.
Right. That's why I always tell people, I go, if you look long enough on the internet, you'll find 100 people that hate puppies.
That's right.
And who in the hell could hate puppies?
Oh, I know.
I don't understand.
Who are these internet trolls, too? I mean,
I'm allergic to cats, and I'm not a big fan of cats. But kittens, they're cuddly.
But the important thing is, what's the old song, the line in the song even? If you don't stand for something, you'll fall for anything. At least get started and, sit down and we can help you with a plan. And at least you'll have that. You can refer to it. And it'll just make life easier for you.
Oh, yeah. All right, what's our next question?
All right, let me look. Short one. Could you go over the RMD rules, which is required minimum distribution is what that acronym is for. Required minimum distribution. Could you go over the RMD rules?
All right. Well, once you turn 70 and a half, you have till April 1st, the very next April 1st, to take out a percentage of that retirement account. Otherwise,
and I believe you divide your 401k, your retirement accounts by 27.4 for the first year, and that's the amount.
That's current actuary table, so that could actually go
it will
a bit later.
It will change.
So, it's about 3.5% if you're married to the person about the same age.
Yep, just under.
Now, if you're married to somebody younger, you can actually factor in up to 10 years age. So if you're married to somebody 50 years younger, you're one of those 70-year-olds married to a 20-year-old.
Why are you
only
laughing?
Factor in 10 extra
Why
years.
are you laughing, Victor?
No, you can only do 10 years in that case. But they can factor that to give you a lower RMD. If you fail to take out your required minimum distribution,
50%.
The penalty is 50%. 50%.
Ouch.
I always think 15. No, 50. It is nasty. You do not mess with the IRS ever. 50% is not good. Now even though you got to April 1st, I'm sorry.
No.
April 1st, you'll probably want to take it out the year you turn 70 and a half, by that December. Otherwise, you'll have two payments coming out the next year, and that might be hard to plan.
Something that may help you if you've got a couple of 401s, which as they become self-directed, meaning you're separated service and you're managing them now, they may be IRAs. But if you have several different ones, most people do, you just have to satisfy the aggregate. In other words, a total of all of those. But it really doesn't matter which of those accounts. You don't have to take it precisely from each account.
That's right.
You just have to take that amount to satisfy the aggregate.
Let's say you've got 4 different IRAs and they total up $1 million. and it says you're going to have to take out 35,000 RMD. You can take it out of one, a little bit out of each one, and where it's up to you. Remember, the only thing that does not count is a 401k if you're still working there. If you're still working there, you do not have to take out RMDs no matter what your age. But as soon as you leave, then you got the RMD, or you roll it out of into an IRA.
Right.
Whatever the case is, those RMDs will come back to get you later. All right, what's our next question?
All right. I've been told that I can't roll over my 401k because I transferred an IRA from Fidelity to Vanguard already this year. I've done it before, so why can't I do it again? Oh, yes. I didn't get it when I was reading it, but now I got it.
It's basically somebody used to could unlimit rollovers. Now, first we have to define what is the difference between a rollover and a transfer. And the truth is that they call them all rollovers.
True.
But there's a very distinct difference between an IRA rollover and a transfer. A rollover is when you leave a company and you have them cut you a check, and you have 60 days to put that check back into an IRA. Otherwise, you're going to pay the penalty and the taxes and all that kind of stuff.
Now, in the meantime, you could deposit in your bank account if you want.
That's right. And do whatever you want with it.
Yep.
A transfer is you take that 401k and you transfer it to an IRA somewhere else. That doesn't count. What the IRS did a while back, is not that far ago, is if you do one rollover, means you can never do another rollover on any IRA. In other words, you can't cash out any of your IRAs. I don't care if they have nothing to do with that 401k for an entire year. So if you come into an emergency and you got to have money, you can't do it. So the key is never get it put in your name. It's always a transfer if it goes transfer. But anytime you take money out of there and do a rollover, you cannot do it for any of your retirement accounts for an entire year.
And I assume somebody or some folks were taking advantage of it. They'd put it in take the amount out, put it in their own name, and on day 55, they get it into an IRA, and then they take it out again, right? And they keep rolling the money out.
Yeah, so also remember that not only do you have taxes due if you don't, there's penalties due and all that kind of stuff. You got to be very, very careful when you're doing rollovers. That used to be a quick thing. So brokers, they didn't want to go through the transfer process. So they tell you, just get a check in your hand. They don't do that anymore because it's a potential nightmare down the road if you're trying to. But now, what are the rules with remember, rollovers? If you get the money put in your name, you can only do it once a year, and that's all your retirement accounts. But what if you're just doing transfers, like, Fidelity to Merrill Lynch or this to that? Those, as long as the check is never made out in your name, you can do it unlimited times, as many times as you want per IRA and aggregate or whatever. It really doesn't matter. And so some of these rules are detailed, and some people make mistakes that are, huge mistakes that wreck your retirement. Some people do convert to a Roth in the worst possible scenario that they should do. They still do it because they heard one side of the argument. That's what we're here for. We're here to answer your financial questions. If you come up with any kind of situation that you're not perfectly clear on, call us at 972-715-2424. If you'd like to take advantage of our no-cost, complimentary, no-obligation retirement plan or Social Security Optimizer, again, 972-715-2424. You can always go to our website at ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice